And so that was the start. I bought the first property at the age of 20 with some bartending money I'd saved up, and then a relationship I'd built with a private investor through David's network. More and more difficult to find quality assets in quality markets. So today, we take a slightly different approach. We did well. We exit out just because it's like, you know what, we don't have to. We're not required to deal with this. Let's just buy somewhere else where it's a little less stringent. And so.
Hi, I'm George Pino, the CEO of Commercial Brokers International. And today I have Kevin Bupp with Sunrise Capital Investments. He's also an author of The Cash Flow Investor, How to Create Financial Freedom Investing in Commercial Real Estate. Kevin, your book, actually, the title caught my eye because personally, I'm a cash flow investor. And I think a lot of the people are out there are going after appreciation. Their old saying that when the tide rises, all boats rise when the tide comes in. And, there's been a lot of people that have jumped on the bandwagon and they were going when the markets were going up and doing well. But when the markets turned, they weren't really set to adapt there. And, I learned early on in my career as a cash flow investor, I wanted to actually purchase the property. And as long as it cash flowed, then I knew I was going to be safe. It was my mitigation of risk because most of my investments are for my, not for business, but more for my retirement. So I'm actually looking at asset preservation as well. Everything I buy cash flows fairly well. And so I know that in a down market, I'll still be able to make mortgage payments. I'll be able to refinance. I typically do lower debt leverage and stuff. So your whole book, actually, and even the thought process, because not too many people talk about cash flow investing. They just talk about real estate investing and they look at the appreciation because that's usually the biggest jump. But I think cash flow plays a really important role. So, tell me about your genesis, how that came about, how you decided to become a cash flow investor, and how even you got started even in commercial real estate.
Yeah, and we'll do, George, and appreciate you having me here. Excited to be here, and I'll try to keep the story somewhat short and condensed. I've been a full-time investor my entire adult life. I like to joke and say that I've never had a real job, so bartending is about as close as I got. Well, I had a lot of fun there, but definitely I wouldn't think that gets bucketed as a real job. Just kind of a side hustle where you can make some pretty good money and meet some fun people. But with all that being said. I got started in single family like a lot of folks do, and I was 19 at the time. Met a gentleman that was about 25 years my senior. Met him through a girl I was dating. Her mother was dating him, so like she was recently divorced, and they started dating. And come to find out, he was a local real estate investor. I grew up in a very blue collar family. Both parents worked. Never had a lot, but also never went without. We weren't poor, but we surely weren't rich either. And that's. My understanding about life was you grew up with the high school, potentially went to college. None of my family went to college. For the most part, my brother was the first of our family that actually went away to school. Everyone else basically went into the trades of some sort. And so like that was kind of expected, like go get a job at the post office, go UPS, someone that's got good benefits and there's some opportunity to maybe grow within the organization. Like that would have been perfectly fine in everyone's eyes if that's the path I chose. However, I didn't choose that path. I didn't know what path it was going to be, but I got lucky at the age of 19 where I met David, who ultimately became my first mentor. And so I befriended David for about a year or so, just getting to know him, seeing him over at my girlfriend's mother's house. I was going to community college, attending bar in the evenings, and just getting to know this guy. And over time, we became, I guess you could say, friends. And he invited me to a conference in Philadelphia, and that conference was basically how to fix and flip houses and wholesale houses. Like that wasn't his business per se. He was a single family guy, had some smaller multifamily stuff, but mostly he was a buy and hold. He surely would sell things here and there. There had been instances where he had, fixed something up and flipped it if it wasn't in the right neighborhood that he saw a long-term vision in. But he was mostly a buy and hold, a cash flow investor. He lived on the cash flow. He let the tenants pay down the mortgages. And I didn't know anything about the business other than what Dave told me, and my parents didn't own investments. They didn't own rental properties outside their 401k was their investment. And they let that thing ebb and flow with the market, right? It went up, it went down, depending on what the market was doing, but it wasn't really an investment. It was kind of a set it and forget it for them. But long story short, fast forward, went to this conference with David. came back and basically offered my services for free to him. I offered to work for free, just so I could be around him in a more professional setting and get to understand his business. And that was it. I was 20, bought my first property after spending a good bit of time around him and just understanding the lingo, what he said, how he said it, who he said it to. The good, the bad, the ugly, everything in between. He was kind of a solopreneur, and so he outside of contractors and things like that, he basically ran everything, his entire portfolio. And so I got to touch every different piece of it. And so that was the start. I bought the first property at the age of 20 with some bartending money I'd saved up, and then a relationship I'd built with a private investor through David's network. And that was the kickoff of it. And from that point moving forward, I'm not a big fan. Even today, I'm not a big fan of reinventing wheels. What David did seemed to work, and I didn't see a reason to try to do it any differently. I was forced to do it slightly differently in the beginning. I realized that I bought that first property, fixed it up, rented it. It was a couple $100 a month of cash flow. I realized very quickly I had used all my money up. It was going to take quite some time before I could even do a refinance, and it would take quite some time before I could save up enough more money for another down payment on a property. And I just didn't really have the relationships or the track record yet to find a private investor to maybe fund the entirety of the endeavor without me putting skin in the game. And so I morphed my business slightly in the beginning for the first 2 years, where I would wholesale 3 properties, keep one, wholesale property, 3 property, 2 or 3, and then keep one. And I did that until I developed more relationships, developed some real money, like a war chest that I could start again, kind of multiplying my efforts with. And so that was really the beginning. In my early 20s, I built up quite a big portfolio of single family homes, about 122 at the peak, and a few hundred multifamily doors. And then, nearing the Great Recessionary period, leading up to that, I started dabbling in commercial. That was my first introduction to commercial. Because what I realized, George, is that I spent a lot of time building that portfolio of homes. It was great. It was inefficient as hell, though. I mean, just spread out all over multiple different counties, and lots of small deals, and it took a lot of effort. And I'd met a guy that owned some retail properties, and I was just enamored by his one 10,000 square foot out parcel center that had 5 retail credit tenants in it. That thing literally made him, after debt service, and it was a triple net, but basically after all of his expenses, he ended up putting $5,000-6,000 a month in his pocket, and that blew me away. And so anyway, I started down that path of commercial real estate, bought some commercial properties, and then basically landed in 2011 with what we really focus on today. So now we've been at our current focus, or our business model, which is it's really 2 verticals, but primarily mobile home parks. And then the second vertical being parking facilities. So parking lots, parking garages, and very strategic locations. So, but I've owned just about everything over those years. I've owned industrial, medical office, self-storage, office, retail, basically everything. And I like focus. So I try not to chase shiny objects. And again, 2011 is really what opened my eyes up to mobile home parks. And I've been in love with it ever since. And that's really where we spend 90% of our focus today within the company.
Okay. Now, when you're looking at, speaking of which, since you are a cash flow investor, I assume with the mobile home parks, you're looking at basically potentially some sort of value add where you might be able to either increase the amount of lots or increase the rents by adding some additional amenities or so. But are you looking at anything for instance, I know a lot of investing in mobile home parks, at least in Southern California, is more about control of the land for redevelopment, because there's a lot of, in these infill areas, it's more about control of the land than reflipping it out to a developer down the road in a few years, that as you either parcelize it out or work on whatever else and, get the entitlements for that. Are you ever looking at stuff like that, or are you just planning on just holding?
We're not a development group. We don't speculate. That's not really our business. And while there's nothing wrong with that business model, it's just that's not really a cash flow play. Most developers that take that strategy, it's more of a, they call it a cash flow covered land play, but typically the cash flow doesn't entirely cover all their carrying costs, while they go through the development and entitlement process. And so again, that's not how we do it. We've got to be able to make sense of the economics today as it sits in its present state as a mobile home park or as a parking facility. Now, with that being said, and I think this is probably this would be more geared towards the parking stuff that we buy. Most of I can't think of one of the mobile home parks that we own in our portfolio, which they're in great locations, they're in great markets, but they're
Mhm.
not necessarily in an area to where the underlying land value is greater than that of the current use of a mobile home park, right? And that might be the case 10, 15, 20 years from now, but
Mhm.
that is not the case today of any of the parks I can think of that we currently own. With that being said, parking lots. Very different business strategy there to a certain degree. Anytime we buy parking, it's got to be an irreplaceable location. Most of what we buy is in downtown CBDs and some of the fastest growing markets in the country. But even then, it has to make sense today as parking. Like it's got to stand alone as parking based on the current income and what the future opportunity looks like as far as, adding value, increasing cash flows, boosting revenues. And then, hey, if 10, 15, 20 years down the road, it's got a higher and better use and it's worth more to a developer than that of existing parking, then to us, that's icing on the cake. But it's got to
Yeah.
make sense today. And we have to see that it's got legs for like at least the next 10 to 15 years in its present state based on the market it's in, demand for parking, and really the strategic location within that
Mhm.
marketplace.
That's actually it's interesting to hear, and it's good. It flows very much with your philosophy, and it's also very much like my investment philosophy as well. I typically will only look for properties that will stand on their own, that will be strong on a cash flow play. I'm not looking at depreciation. In fact, if I am looking at all for any kind of appreciation play, then I'm extremely underwriting it conservatively, typically at about half the average of what it is. And that then allows me to, as you say, keep going. And it's just a bonus, it's
Yeah.
icing on the cake. And
Yeah.
it's worked really well for me. However, I also know I syndicated properties as well.
Mhm,
And a lot of times on the syndication, most of the money is made on the back end where on the sale or the appreciation that you're doing.
mhm.
Um, and are you looking at exit strategies for those specific type properties that may be what does your investment horizon look like?
Yeah, that's a great question. And I would say that it's changed over time. And we've gone full cycle on 18 mobile home parks at present time. However, I think our investment philosophy is very different than that of most syndicators, and uh, a lot of it directly ties to the types of assets that we're buying. So let's talk about mobile home parks, for instance. It's one of the few asset classes. Really, parking is the only other one, but mobile home parks is one of the few or one of two asset classes that has a diminishing supply, meaning that there's very little new supply coming on the market, and there's a lot of parks that on an annual basis that get, as you mentioned in California, it's kind of a covered land play, but ultimately it's in a prime location. It's going to get redeveloped at some point in time in the future. Well, that is happening across the country, and so there's no new supply coming on the market, and so that creates a challenge. It's good and bad. It creates a supply demand imbalance, which you know whenever we're ready to sell something, it's got a lot of buyers. There's a lot of institutional capital chasing after it. Mobile home parks are trading at compressed cap rates. In fact, per Green Street data, the last couple of quarters, it's literally has been trading at much lower cap rates by roughly about 30 to 40 bips than even multifamily, Class A multifamily. So, it's great on the exit. However, it becomes inherently more challenging to replace it, to go buy another one, because we're literally fighting after the a limited supply or diminishing supply. And so we've really morphed our strategy over the last couple of years in that uh, they say like the best and worst days of owning a boat is the best days when you buy it, and or I'm sorry, how's that go? Basically, it's when you buy it, and then ultimately when you sell, it's like the best
You
day, like
sell it.
just trying to
Yep.
trying to get
The
rid of
two
it.
best
Like I,
days.
I feel kind of the same with parks. It's we buy it, we've done our value add, we make a ton of money, we exit, we pocket a fat check, we give a lot of money back to our investors, and everyone's happy. However, now we got to go on the hunt to find another one, and every single month, every single year, it gets more and more difficult to find quality assets and quality markets. So today we take a slightly different approach. As far as you asked me the original question, our investment horizon, and we say 7 to 10 years, potentially longer. And what I mean by that is we do fund structures. We don't do standalone syndications. We end up having between 10 and 12 properties in any individual fund. And we're very specific about the investor type that comes with us as well, along for the ride. We're very keen on making sure that we're not getting someone in that's expecting to recycle their capital every 3 to 5 years. So that's not our business model. It's a much longer horizon. On top of that, there's a good chance that we're going to hold a number of those assets for for maybe in 15 or 20 years. And so it's a more of an investor that's looking for wealth preservation. They maybe have made most of their money, looking just for very steady, repeatable, consistent returns on a monthly, quarterly basis. Give me good, solid returns on great projects that are in great locations that I can just rely upon. And I also don't have a tax consequence every time you turn around and sell something, right?
Right.
Again, great day when you sell something for an investor, but also on the flip side of that, you create another challenge for them by giving them a tax burden, recapture from depreciation and also capital gains. And so
Yep.
we really focus on our long-term horizon because we can't replace these easily. On top of that, we want to hold on to these prime assets because, again, it's hard to find the next one in line. It's really difficult to replace it. So now we just recap. We do cash out refinances. We do sell a few assets out of every portfolio, but we identify what we feel are the cherries, which are the out of the 10 or 12, which are the 5, 6, or 7 that are just, these things have exceeded expectations. They've just blown it out of the water. We'd be silly to ever replace these. So let's do a cash out refinance,
Cash out refi and then
exit,
just, yeah.
divest of the other ones that are in the fund that we maximize the value on. We don't necessarily see a long-term future for whatever reason. Maybe it's a market. Maybe we haven't been able to get a bigger footprint in that marketplace. Whatever the reason, divest of a few, keep the majority, and then long-term vision for us is inevitably, in fact, we've already started the process as far as doing roll-ups out of our older funds. And so for investors that truly they want to be cashed out, they've been in and out for 7, 8 years, they want cashed out. There's always a contingent of those that just, they're okay with the tax burden, they want to get cashed out, they want their money and go do something else with it. But then there's plenty of others, like I said, we're really focused on is like, guys, just keep me in my checks. I don't want to go put the effort into finding something else. Can you just like roll it into your next thing? So now we've collectively started doing that with old funds, rolling them into new funds, and giving the opportunity for folks to cash out who want, but those who want to continue with us can just continue down that same path that they've been on. So
Sure.
yeah, ideally, I would like to hold everything. That in a perfect world, I'd like to hold everything forever. Parking's the same way. They're not making more parking. They're not building more parking. Most large cities across the country have removed the parking minimum requirements, meaning that when new developments go in, condos, hotels, multifamily properties, historically they used to make developers build a certain amount of parking per every 1,000 square feet, right? That formula has been eliminated for the most part from major cities. So now developers get to build as much as they need, not excess. In fact, they make more money by building another condo unit than they do building 2 parking spaces, right?
Sure.
And so that's actually creating a limited supply and a constrained supply of parking in most major cities as well. So again, for that reason, I want to buy parking in the prime location, knowing that like more than likely new parking will not be built. If anything, it's going away. It's dwindling in supply. So.
Absolutely. No, I love that. And something you mentioned a little bit, location, I've heard that a couple times. And location, obviously, everyone's heard the terminology, location, location, location for, what's the most important thing in real estate. I do agree with that, but, generally speaking, when someone talks to me and I'm onboarding or talking to someone about my investment strategy, I tell them that I'm geographically agnostic, but extremely location driven. Are you doing
That's
that
right.
same kind
Same
of
thing.
philosophy? Because I mean, obviously with a limited supply, you're not buying every mobile home park in Tampa.
That's right.
So
That's right. You're exactly right. I mean, I would say somewhat geographically agnostic. There are areas that we won't go. I just, life is too short to try and do business in states like New York. I know you're in California. So no offense to California. It's just a much more challenging set of rules to play by, and many folks do incredibly well, and like they know how to navigate those nuances, right? And we owned interestingly enough, we owned in New York for many years, and statewide rent control got passed in 2019, and just we did well. We exit out just because it's like, you know what, we don't have to. We're not required to deal with this. Let's just buy somewhere else where it's a little less stringent. And so we typically stay away from New England states. And we have not bought anything in California, not saying that we wouldn't, and we haven't bought anything really along the entirety of the West Coast. A lot of it's more of from a proximity perspective, just because it's such we own something out in the Midwest, but like once you start, unless you can get some scale
Yeah.
out in one geographic location, you create more inefficiencies than it's worth. And so for that reason, we haven't really bought anything out in the West Coast either.
Yep. I know.
But
I
if the
completely
deal's
understand
right,
that.
we'll go. If the deal's right and it's big enough, we'll go.
Exactly. Yep. That's kind of the same philosophy that we have out here for our investments, and we have them throughout the. But I mean, we're primarily investing in single tenant net lease assets, which is a little bit
Hmm.
easier to navigate around any
Yep.
kind of restrictions. I mean, we were big multifamily investors at one point, and frankly, due to a lot of the regulations and governmental oversight, we decided to pull out
Hmm.
and go into different asset classes. It was just too much of a headache and too much of a concern. And I think that also is something that you want to take a look at when it comes to your investment is the time that you spend. A lot of people don't really take that into account that, what is my time that I'm going to do, which is fantastic for your investors because they're really using your time and getting paid for it.
Yeah.
Your investors coming in. So that's a great way for someone to come in, do real estate and get the benefits of real estate without actually managing it or taking it on, but using your expertise in that.
Hmm.
Um, so when it comes down, overall though, in general, um, I completely understand being, you want to be pick and choose where you're going to be, but ultimately though, if it's the right property, large enough to make sense, so you'd
Hmm.
have the synergies out there, then you decide to strike on that. Now, luckily you're in probably a better position, much larger investor than your typical mom and pop, and that's out there. Um, would you recommend for someone that's really kind of mid-level, just, they're starting to grow their portfolio to really just concentrate? I mean, there's old sayings that, one of the funny when we first started investing out of state, um, Texas was one of the markets, and a lot of the old Texas people said, where's California equity go to die? Texas, because people in California are selling a property that is 5 to 10x on a per
Yeah.
door basis and purchasing a apartment building in Texas thinking it's going to run the same. And it's, they get into it and get over their head, not understanding that. What would you recommend for someone that's looking to expand outside of the area, how to mitigate that risk?
Yeah, it's a great question. I think you have to look deep inside first and foremost. I mean, I've got I think it depends on how resourceful you are. Like, where's your personal expertise lie today? So, for example, the first mobile home park that we bought, so most of my portfolio prior to that first mobile home park, most of the things I own single family wise and multifamily were here in the west coast of Florida. They were spread out amongst 5 or 6 different counties, which is a pretty big geographic region, but they weren't my backyard, but they weren't too far away. They were, all within a maximum 3 hour drive in one direction. Um, and so I could get to them, right? But that first mobile home park that we purchased it was in Atlanta. It was 8 hours, 8 hour drive away from here. And however, I've run multiple construction crews amongst many different projects. I'm comfortable with that. Like that's not out of my comfort zone. I'm pretty resourceful with actually finding local talent. As far as finding the teams that are necessary, finding a part-time project manager, and just using technology even to help run that project in my absence, because I would go up once a week, right? I'd go once a week and spend 2 days there, and then I would come back home to Florida. That was comfortable for me. I was okay with that. It had some challenges, but I'm pretty resourceful. And so if you're that same type of individual, you're resourceful, well, you're figured out one way or another. Technology has allowed us to be much more efficient with how
Yes.
we do things, right? But if that makes you uncomfortable, everything I just said there, if that makes you uncomfortable, then I would say that you absolutely should stick with your backyard, right? Until
Yeah.
maybe you can gain some just a little bit, expertise, time. It takes time to gain that, and so as far as mitigating that risk, if you're okay, if you're still not okay with it and you want to buy, you find an opportunity out of state or out of your market, then again, maybe it's partnering with someone that's got more
What's
localized
local?
knowledge, right? Yeah, absolutely. I mean,
Sure.
someone there's got localized knowledge, and someone there, if it's that great of a deal, you shouldn't have an issue with finding somebody, convincing somebody to run alongside you and work with you on the project, so that ultimately both of you can win, right? I personally think it's harder to find that localized knowledge that you can trust that has a alignment of interest with you than it is just me kind of using my resourcefulness to run the project remotely. But again, that's me.
Yeah.
Someone else might do a much better job of finding, building local rapport and finding someone that they can truly comfortably partner with, have a partnership with. So
Absolutely. And, I agree with you there. That's some great advice. And also, I promised to keep this to about 20, 25 minutes, and we're at that mark. But one of the things I do want to say is that anyone that is, number one, wanting to get started in investing, but they're not quite sure how to do it, take a look at the syndications. There's an opportunity there.
mhm.
We're going to have all the contact information for both Sunrise Capital Investments and also how to get a hold of any of those books if you want a little bit more of a guide of how to go about it on your own as well. But stay tuned, take a look at it, and I appreciate your time here, Kevin. This has been very
Yeah.
informative. I think across the board from both people starting off as well as in the middle levels.
Mhm.
And even some that are perhaps high net worth individuals but don't have a big real estate portfolio. You covered some great points here that can work for all of them, and I love that. And so, if you also loved what you heard, don't forget to hit that like button, and if you haven't done so yet, don't forget to subscribe. And look forward to seeing you on the next video out there as well. So, thank you all for joining in.